Today, we're reviewing an analysis report on Navitas Semiconductor, or NVTS.
It's seen incredible gains, about 160% year-to-date.
And this analysis is asking if it's set for another breakout, hinging on a big pivot to AI data centers.
Right, using GaN and SiC chips.
The core thesis is strong, but the bridge from today to that future needs some reinforcement. Let's jump in. The analysis correctly identifies that the strategic pivot to AI data centers is the main catalyst for, this explosive future growth.
That part is spot on.
But the connection between the current financial transition and this future massive revenue ramp-up, it needs more objective support to really justify that high valuation.
It really does. The weakness is that the report seems to lean very heavily on management's own forward-looking statements.
Exactly. That projected revenue bottom in Q4 2025.
And the huge ramp-up in 2026 from AI partnerships. It's all based on their forecast.
Right. And the analysis presents these claims without a lot of verifiable details, like the size, the scope of these new commitments.
So the logic is a bit too reliant on the promise, not the documented market opportunity.
And that is the central issue, isn't it?
It is. The report is essentially asking us to accept a market cap of, $2.18 billion today?
For revenue that might not show up for 2 more years.
To justify that, you need more. The suggestion is to really bolster that core thesis. Integrate specific data points that validate the magnitude of the shift.
The shift from, lower margin consumer electronics?
To these high-margin AI infrastructure contracts. The report has to show how today's valuation is warranted by tangible opportunities in 2026.
I agree. Right now, that narrative is compelling, but it feels like an empty container waiting for facts.
A good way to put it.
So to fill that container, instead of just generalizing about AI partnerships, the analysis could get really specific.
How so?
Well, it could bring in details on the power consumption and density requirements of modern AI servers.
So the technical specs.
Exactly. We know AI needs just massive power density. We're talking specific kilowatt per rack figures that, traditional silicon just can't handle efficiently.
And GaN and SiC are essential for that. But the report needs to quantify the dollar value of that necessity for a company like Navitas.
Yes, go beyond just saying the tech is superior and actually define the size of the problem.
So for example, if a hyperscaler is building a new data center that needs X megawatts of advanced power management,
and Navitas has a solution that saves Y% on cooling or space.
that translates directly into a verifiable revenue opportunity.
That specificity is absolutely crucial. It creates that quantitative bridge we were talking about.
It turns an optimistic curve into a calculated trajectory.
Because right now, the massive ramp-up is just a function of time, not volume.
And if those internal details are hard to find, which they often are,
Sure.
the report could look at competitor benchmarks or even third-party market size projections for GaN and SiC adoption, but specifically in the enterprise and industrial power sector.
And contrast that with their current revenue.
Exactly. Contrast the potential market size against their current $56 million in TTM revenue. That would give the ramp-up a concrete scale.
It converts that future hope into a defined market share potential.
It certainly does. It turns the qualitative story into a quantitative thesis.
And speaking of rigor, the volatility around the stock is a really compelling part of this piece, but it feels a bit isolated.
I was thinking the same thing. The uncertainty around hitting that 2026 goal is what's driving all the current market drama.
It's a perfect transition because that volatility is a huge part of the whole investment opportunity. The report does a good job identifying the technical setup, the $9 support level, the consolidation, the high short interest.
All pointing to a potential short squeeze.
Right, but it could be so much more powerful if it wove that volatility directly into the fundamental growth story.
I agree. As it is, the weakness is that these technical factors are presented as almost standalone trading opportunities.
It compartmentalizes them.
And that makes the volatility seem kind of arbitrary, rather than a logical consequence of a high-growth company in a major transition.
I would even argue that just focusing on that $9 support floor without explaining why so many sophisticated traders are betting against a company with a 160% gain this year, that's a huge missed opportunity.
It is. So the suggestion is to integrate that high-risk, high-reward setup right into the core thesis.
Frame it as a battleground.
Exactly. A battleground between skepticism, which is fueled by the current unprofitability,
And the aggressive optimism, fueled by that 2026 pivot promise.
It's a much more powerful reframing. The technical analysis stops being just lines on a chart and becomes a real-time drama.
So to do that, the report needs to connect the high short interest directly to the fundamentals,
To the skepticism.
to the 32 times price to sales ratio, and that pretty hefty negative operating income of minus 96 million.
That's it. The short sellers aren't betting against GAN technology itself.
No.
They're betting that the company cannot sustain a 32x PS valuation for 2 years while it's losing money. The technical pressure is just a direct, measurable market debate.
And that makes that $9 support floor so much more meaningful.
It's not just a technical bounce point.
It's the line in the sand where the bulls and bears are fighting it out over that 2026 promise.
And to really illustrate this, the report should use the analyst targets.
The spread is pretty wide.
It's huge. The average target is around 844, but the high target is 1365. That spread isn't random.
It perfectly encapsulates the divergence in sentiments.
Yes, it's why there's so much consolidation. That $9 floor is holding because the optimism about the AI pivot is just strong enough to counteract the negativity about current profitability.
By doing that, the analysis stops being a checklist of technicals and becomes a compelling narrative. It links the chart to the cash flow.
Which is exactly what a sophisticated analysis should do.
And that link between the chart and the cash flow brings us straight to the third point.
To the justification for that sky-high valuation in the first place.
Right. It's a natural segue, so the report is transparent about the current financial pain points, the operating income, the aggressive PS ratio.
It lists them clearly.
But it misses a huge opportunity to really justify why the market is willing to accept these metrics right now.
The rationale is a bit abstract.
It is. It just says explosive growth expectations. For a detailed financial analysis, it's not enough.
The weakness is that accepting such an aggressive multiple on only $56 million in revenue requires a much deeper defense, rooted in the company's actual financial structure. And when you're looking at a company in the middle of a pivot like this, it's almost like a biotech stock, you know?
Where the big payout depends on future trials?
Exactly. And in that situation, the balance sheet is the only thing that provides any real stability.
It's the anchor.
The suggestion here is to use the existing balance sheet metrics, that $160 million cash pile versus the relatively low $59 million in debt, to build a clearer narrative around financial resilience.
Show that this flexibility is the key mitigating factor that justifies the market's aggression.
And that it allows them to sustain the losses until that 2026 ramp-up happens.
This framing positions the balance sheet not just as a summary, but as an insurance policy for the whole investment thesis.
Precisely. And this is where the analysis needs to get systematic and actionable. The most compelling thing to add would be a calculation of the company's financial runway.
Okay.
We know the TTM operating income is negative $96.5 million, so you can calculate the approximate burn rate.
And show how long the cash will last.
Yes! Explicitly calculating that their $160 million in cash gives them roughly 1.6 years of operational capital. That's essential.
And that 1.6 years isn't just a number.
No, it's the financial window. It's what the market's optimism is trading on.
The moment that runway looks like it won't be enough to reach that Q4 2025 revenue bottom,
that 32x multiple becomes completely indefensible.
So stating that calculation links the balance sheet directly to the long-term thesis.
And on top of that, the analysis has to emphasize the low debt. $59 million is not a lot.
It's a key structural advantage.
It is. It gives them the flexibility to execute this capital-intensive pivot to AI data centers without being choked by debt covenants or needing to do a major dilutive financing round right away.
It's their safety net.
It is their safety net. And by framing the balance sheet that way, the financial story moves from they expect growth to they have the capital structure necessary to achieve that growth. It's a systematic justification for the aggressive multiple.
Okay, that's a really powerful set of actionable steps. So to summarize the main opportunities for improvement here, first, we need a much stronger validation of the scale of that 2026 AI revenue ramp-up.
Anchor it with specific, quantifiable market data.
Right, using industry power requirements or verifiable market size projections.
Second, the imperative is integration. Stop treating the technical volatility and the high short interest as standalone factors.
Weave them into the fundamental uncertainty of the pivot. Make that $9 support floor the battleground between conviction and skepticism over the valuation.
Exactly. And finally,
a systematic justification for that aggressive 32x price-to-sales multiple.
which means calculating and framing the cash runway.
Use the cash and the operating income to show that the company has enough operational capital to reach that 2026 inflection point without an immediate liquidity crisis.
All of these suggestions are really about providing clear quantitative support for what is currently a high conviction, but also a very high risk qualitative thesis.
Incorporating these elements will make the analysis robust, logical, and fully supported.